Lecture 5, Risk and Return. In this lecture, we will introduce the calculations of risk and returns, including the expected return, which is the mean, the risk measures of returns, which includes standard deviation and variance. Then we're going to introduce historical return distribution and introduce the allocation problem 1, which is allocation between one risky and one risk-free asset. Risk aversion coefficient will be introduced. Capital allocation line and Sharpe ratios will be discussed. To understand the distribution of historical returns, we start with the definition of return. Holding period return, HPR, is defined as the capital gains plus dividend distribution divided by the initial price. Capital gains is measured by the difference between the current and the initial price. For instance, if the beginning price of a share is $20, ending price is $24, during the period, the dividend distribution is $1, assuming occurring at the end of the period. What is the holding period returns? Holding period return, therefore, is the capital gain, which is $4 plus $1 dividend distribution, divided by initial price 20, which yields 25%. So this is the return we typically download from databases that includes dividend distribution. Let's look at rate of return for a mutual fund. In this case, we'll understand how to calculate the average return using different measures. See, this mutual fund will look at the return for the first to the fourth quarter. It says the asset under management that's changing over time. The holding period return, which accounts for dividend distribution and capital gains, is 10% in the first quarter, 25% in the second, negative 20% in the third, and positive 20% in the fourth. And there's different inflows and outflows. And inflows is positive, outflow has parenthesis meaning negative. Okay, and therefore, to calculate the average return for this mutual fund, we can follow 3 different methods. We will focus on the first 2, arithmetic and geometric. Then we will quickly introduce the third one, which is internal rate of return. Arithmetic average return ignores compounding. It refers to the simple arithmetic average of quarterly returns here. So in this case, we want to calculate the average between 10, 25, negative 20, and 20. In contrast, geometric average return is a time-weighted average, which accounts for compounding across time. So we're going to do a compounding using the realized return for each quarter. Then we're going to find out the geometric average return per quarter. In the first calculation, the average arithmetic mean return is 8.75%. In the second calculation, we compound the 10%, 25%, negative 20%, positive 20% for the 4 quarters and take the exponent of an exponent of a quarter minus the principal 1. The geometric average return is 7.19%. So basically, the compounded return using the 4 realized return is equal to the compounded return for the 4 quarters using the geometric average return, 7.19%. So geometric average represents the actual growth in the money in the real world. So that's why mutual funds have to report geometric average return per SEC regulation. Usually, geometric average return is below arithmetic average return because arithmetic average return doesn't account for volatility. Arithmetic return is equal to geometric return plus variance of return divided by 2. So that's why they have this relationship. The third method is the internal rate of return. It's also called the dollar-weighted average return, which accounts to the different money invested at different point in time. Okay, so in Excel, you want to tell the function IRR the cash inflow and outflow. And in Excel, you want to make cash inflow to be a negative sign and cash outflow to have a positive sign in order for the function to solve for the internal rate of return. So mathematically, the internal rate of return is an average discount rate that would make the present value of the future cash flow to be 0, accounting for the initial and ending balance of the funds. And this calculation generates 3.38%, which is lower than geometric average because investors do not buy and hold in this case. Instead, they trade in and out, which causes the return to deteriorate relative to the buy and hold strategy. So let's look at an exercise. If you are given 3 returns for a stock for 3 years, the arithmetic average return will be the average of the 3 numbers, which gives you 3.15%. The geometric average will take the compounded form, compound 14% with negative 14.55% with 10% for 3 periods. Take exponent of 1/3 minus 1, you have 2.33%. To quantify the risk-return trade-off of a given financial assets, one of the most popular ways is to learn from the historical returns. Typically, for a stock or bond portfolio, normal distribution provides a good approximation of the underlying distribution. To describe a normal distribution, we need 2 important parameters. One is the mean. We can use arithmetic or the geometric mean. The other is the second moment, which can be represented by either the variance or the standard deviation. Both are called the volatility or risk. Variance is squared standard deviation, so they have a 1-to-1 mapping. A normal distribution is symmetric. It has a mean, which is the center, that's equal to the median. And the standard deviation tells you the probability a certain range of outcomes can be observed. One standard deviation above and below the mean has 68.26% of probability to be observed. 2 standard deviations above or within the mean have a corresponding 95.44% of probability to be observed. An observation within 3 standard deviations to the mean has 99.74% probability to be observed. So historically, SP 500 has a mean close to 12%, standard deviation roughly 20%. Therefore, this graph give you approximation of the typical annual rate of return of S&P 500 to be observed in history. How do we estimate mean and volatility using historical returns? We have two methods. One is using the calculation. The other is to use the Excel function. Average refers to the summation of the return divided by number of observations. Excel function corresponds to average. For volatility, you can use the Excel function var to obtain the variance, and the Excel function stdev to obtain the standard deviation. Typically, you will be choosing between .p and .s. .p refers to the population. .s refers to the sample. In most cases, we use the function with .s because we assume that we have a limited number of observations, so it's only a sample. It doesn't represent the entire population. Some stylized facts based on historical returns. So this table shows that from 1926 to 2010, equity returns tend to be higher than bond returns. And small stocks tend to do better than large stocks. And large stocks tend to do better than long-term treasury bonds. And this pattern have held for the last 10 years also as well. To quantify the trade-off between risk and return, we typically use the Sharpe ratio, which is also called the reward to volatility ratio. So the Sharpe ratio is invented by Professor Sharpe, who is a Nobel Prize laureate for inventing Sharpe ratio and the CAPM. The Sharpe ratio in theory is a ratio between risk premium and risk of the portfolio. Risk premium is the average excess return relative to the risk-free rate for the given portfolio, and standard deviation of the return measures the risk. Using historical data, because risk-free rate changes across time, so the risk premium can be estimated by the average excess return of a portfolio relative to the risk-free rate. Let's look at an example. If the expected return is 15%, risk-free rate is 7%, and the standard deviation is 22%, what is the Sharpe ratio? Follow the formula. You take 15% minus 7, which gives you 8%. 8% is the risk premium. Divided by 22% standard deviation, and your Sharpe ratio is 0.36, which means that if we standardize the risk to 100% of standard deviation, this portfolio offers you the risk premium of 36% per year. So the higher the Sharpe ratio, the better the risk return trade-off for the given portfolio relative to the other. Some calculation you can try to use the historical data for S&P 500. Here, I gave you the average of the excess return instead of the return and risk-free rate, and I gave you the standard deviation. So the Sharpe ratio can be calculated by using the average excess return divided by the standard deviation, which will be for the first time period, 8% divided by 20.70%, you have a Sharpe ratio of 0.39. Similarly, you can do the calculation for 1986 to 2010, which yields a Sharpe ratio of 0.40. I encourage you to check out Professor Kane French website, which hosts a data library of the Pharma French research factors and research portfolios. This is the most popular or widely used data library that's for free on the financial markets. And I want you to download the Pharma French 3 factors, the monthly returns, value-weighted monthly returns from 2008 to 2019, and using Excel to calculate the arithmetic mean, standard deviation, Sharpe ratio of the market portfolio. And the market portfolio can be defined as the market access return, which is the market factor of Pharma French 3 factors, add back the risk-free rate. So this will be a very useful exercise. Examples can be found online. Now let's go to asset allocation. Historical return shows that equity outperform bonds, outperform T-bill, although equity is riskier than bond and bond are riskier than T-bill. So the first asset allocation problem we are tackling is to split the investment fund between one risk-free asset and one risky asset. So the risk-free asset will be the T-bill. The risky asset can be a stock portfolio or bond portfolio, or the portfolio that combines both stocks and bonds. So what is the equation to measure the risk and the return in this combined portfolio? Let's first donate omega as the percentage of funds allocated to the risky portfolio P. 1 minus omega refers to the remaining percentage of funds will be allocated to risk-free assets. When omega is 0, we put 100% money into the risky asset. When omega is 1, we put 100% of money into the risky assets. Sorry, when omega is 0, no risky assets. When omega is between 0 and 1, we have a mix of the two. So we have two important formula to use it here. For the expected return of the combined portfolio, it is a weighted average of the risky and the risk-free return. The weight is determined by omega and 1 minus omega. So it's a linear combination of returns that yields the combined returns. The variance of the combined portfolio, sigma c squared, is equal to omega sigma p, the whole thing parenthesis squared. So if you look at standard deviation, again, we have the combined portfolio standard deviation is a weighted average standard deviation of the two assets. So keep in mind that risk-free asset has 0 standard deviation, therefore the second part of the equation is dropped. We only have omega times sigma p to be sigma c. For example, if the risk-free rate is 7%, risky asset return is 15%, standard deviation is 25%, our omega is 75%. So how do we calculate the expected return and standard deviation of the combined portfolio? The expected return would take the weighted average, 75% away to 15%, 25% way to 7%, and we do the same thing for sigma, while keep in mind that sigma risk-free rate is 0. Then we have that the expected return of the combined portfolio to be 13%, and the standard deviation of the combined portfolio to be 16.5%. Okay, again, this is a weighted average with the second term being 0. The exercise you are given has different parameters, but the calculation follows the same procedure. For the expected return, you take the weighted average. Now the weight is 70% to the risky portfolio, earning 17%, and 30% earning 7%. So in this case, expected return will be 70% times 17% plus 0.3, which is 30% allocation times 7%, that gives 14%. Standard deviation will be the weight, 0.7, times standard deviation of the portfolio, that will be 18.9%. The Sharpe ratio will be the risk-free rate, risk premium, which is 7%, divided by standard deviation 18.9%, that will be 0.37. To summarize, when omega is 0, there is no risk in the portfolio. The portfolio earns the risk-free rate. When omega is between 0 and 1, both the risk and return are a linear combination of the risk and return of the two assets. When omega is 1, the portfolio has 100% risky assets and has 22% risk and 15% return. In all cases, as long as omega is greater than 0, the Sharpe ratio is equal to 0.36. So when we allocate between one risk-free and one risky asset, the Sharpe ratio will always be equal and equal to that of the risky asset. Capital allocation line shows the investment opportunity set by changing the allocation omega between the risk-free and the risky assets. The capital allocation line is plotting expected return against standard deviation and given Sharpe ratio, and this is the equation between the y-axis and x-axis. So you can see that the intercept will be the risk-free rate and the slope will be equal to the Sharpe ratio of the risky assets. And the Sharpe ratio will be equal for the risky portfolio and the combined portfolio. So this line is the capital allocation line. It shows you the risk and return combination for any given asset allocation. The allocation can be as low as 0, omega equal to 0, to as high as omega equal to 1. When leverage is allowed, we can actually increase omega to be above 1. And the slope will be always equal to the Sharpe ratio of the risky asset. In this case, will be equal to 0.36. So the higher the return, the higher the risk, and the risk and return trade-off remain constant across all allocations. But which of the allocation is optimal for a given investor? This will be determined by the degree of risk aversion of the investor, which is denoted as A. So we're going to show that the higher the risk aversion coefficient, the lower the allocation to the risky asset in the optimal portfolio. So A measures the price of the risk the investor demands from the complete portfolio, and the complete portfolio C includes both the risky and the risk-free assets in the optimal combination. To calculate the optimal allocation omega, the equation is that you use the available risk premium to variance ratio divided by the required risk premium to variance ratio. How to measure the available risk premium to variance ratio? You take the risk premium to variance ratio of P, the risky asset. The required ratio is measured by A, the risk aversion coefficient. So omega will be determined by this equation. Give you an example. If market has risk premium of 8%, standard deviation 20%, risk aversion coefficient A 3.91, what is the optimal allocation to the market portfolio omega? Using the equation, we know that we can take risk premium, which is ERP minus RF, divided by A times sigma P squared. Plug in the numbers, risk premium is 8%, A is 3.91, sigma is 0.2, and we square that, and omega should be equal to 0.51, meaning that for this particular investor, the allocation of 51% to the market portfolio is optimal, which will give her the appropriate risk as well as the return. If you are instead given the allocation 75% and other parameters, you can also infer the risk aversion coefficient by solving A backwards using the same equation. Right? So in this case, can solve for A will be 2.67. So the investor with a risk aversion coefficient 2.67 will allocate 75% of her investment into the market portfolio. By the same token, the investor who allocates 75% of her portfolio into the market portfolio reveals that her risk aversion coefficient is 2.67. Lastly, I want to show you how to quickly obtain your own risk aversion coefficient in a quick and dirty questionnaire approach. This approach, we're going to ask you to make choices when you confront risk. The first question asks you to choose between a job that guarantees you with the current income for life versus an equally good job has risk, which has 50-50 chance to double the income or 50-50 chance to cut the income by 1/3. Would you take the job or not? If your answer is yes to this question, you would answer question 2. In this case, you are choosing to keep the job, which is for sure, or you can have a chance to double it with 50-50 chance or 50-50 chance you cut it in half. Would you take the job or not? If your answer to question 1 is no, your question for the second problem is to choosing between doubling your income with 50-50 chance or cut your income by 20% with 50-50 chance. So you should answer 2 of the 3 questions and come up with the answer of yes, 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 no, or no, yes, no, no. Then you basically self-selected into one of the 4 categories. And those categories are corresponding to certain degree of risk aversion. If your answer is yes, yes, you have high risk tolerance. Your risk aversion coefficient is between 0 to 1, and which is considerably low. If your answer is yes to no, and the coefficient is 1 to 2, which is still more risk tolerant than the average. If the answer is no, yes, your risk aversion coefficient is between 2 to 3.76, which is very typical. But if your answer is no, no, your risk aversion coefficient is above 3.76 with mean of 15, which is very high. That's the way, a quick and dirty way to figure out your range of risk aversion coefficient. And with this coefficient, you can go back to solve for your optimal complete portfolio.